So we'll begin with arguably the second most important reading of the CFA curriculum. You can expect about 25% of the morning session to be directly asked from this one reading itself. So there are 35 readings in the CFA curriculum. So after managing individual investor portfolios, definitely institutional investor scores the second highest points. So the reading will tell us as to what are the specifics of managing institutional investor portfolios now. And we'll start by understanding and evaluating the portfolios of various institutions, starting with pension plans, when we'll focus on defined benefit plans, foundations and endowments, life insurance companies, non-life insurance companies, banks, and we'll summarize the relative management idiosyncrasies of each of these funds at the end. So just to revise some pension definitions, the plan surplus is calculated as the value of the plan assets minus the plan liabilities for a defined benefit pension plan. We'll revise the defined benefit and the defined contribution categories next if you've forgotten. But a new term called accumulated benefit obligation that you didn't study at level 2 has now been added. So this is the present value of the liabilities assuming no further accumulations. That is, if the plan terminated today, the company would be liable to pay out the accumulated benefit obligation, which differs from the projected benefit obligation or the PBO that we studied earlier. Please recall, the PBO is also a calculation of the liability. However, it did assume salary increases. If the plan was to terminate today, there would be no further salary increases, and that's what taken into account in the accumulated benefit obligation. The total future liability is another new term, is even more comprehensive than the projected benefit obligation. So projected benefit obligation assumed that the salaries would keep increasing. Total future liability also assumes that more people would get added to the plan. Possibly the retirement benefit itself will get revised upwards. That is, instead of giving 2% of the final salary, employees may decide to give 3% of the final salary as pension. So in that case, the total future liability would normally be higher than the projected benefit obligation to account for any further increases that possibly can happen to the pension plan. Retired lives is the number of plan participants who are retired and are currently drawing pension. Active lives is the people who are employed and are not receiving pension at the moment. Just to revise, in a defined benefit, the pension benefits are a liability of the employer. To be more specific, there is fixed sums of money that the employer has guaranteed will be paid out to the retirees. The benefits are determined by some stated criteria, normally associated with the final salary and the years of service. The plan sponsor, that is the firm, is responsible for managing the plan assets and to meet the pension obligations. That is, all investment risk is faced by the firm. There is no risk on the employee. Whether you're able to fund or not able to fund is your problem. The employee has been guaranteed fixed sums of money that he will be paid at retirement. For the employee, he receives periodic payments beginning at retirement, subject to early termination risk if the employee is fired early, and the employee does not bear any risk and return consequences of the investment portfolio's performance that has been kept to fund these liabilities that the employee will draw in the future. In contrast, in a defined contribution plan, the firm promises to contribute fixed sums every period or every year. So the only liability is to the extent of making these contributions. The plan, however, must offer employees a sufficient number of investment vehicles wherein these funds can be invested by the employees to meet their own internal objectives. In a defined contribution plan, the employee actually owns all the assets and can easily transport the account from one employer to another. He must make all the investment decisions himself, given the available options and depending on his personal circumstances. The investor bears all the investment risk of his retirement. If there aren't enough funds then he may not be able to fund his retirement. In other words, the firm doesn't make any guarantee on the future value. Firm's guarantee is only to the extent of the current contributions. Now, for the focus of the level 3 curriculum, as you can make out, the defined benefit plan is where the institution or the firm is greatly involved and has to ensure the performance and the availability of funds. In a defined contribution plan, the problem shifts to private wealth management, wherein the employee now has to properly distribute the assets so as to meet his retirement obligations. So, in a defined contribution, it will be very individual specific and it will essentially be a private wealth management problem as to which of the investment alternatives to pick, how to invest the money. In a defined benefit plan, it is the firm as a whole that has to meet all retirement obligations. Very quickly, the advantages and disadvantages of each type of plan. So, in a defined benefit to the employee, there's no investment risk and there's stable retirement income. So, planning is easier. To the firm, there is possible pension income. If you manage the plan assets very well, that is the contributions that you had made to fund these retirement benefits, if you generate excessive returns on these assets such that you are not able to just meet the retirement obligations, but you're able to generate income for yourself as well. So, ability to support the stock with some investment to a fair extent in your own company stock for these funds. Disadvantages to the employee, there's early termination risk. There'll usually be a vesting period before which the employee becomes eligible for these benefits, rather after which the employee becomes eligible. There'll be restricted withdrawal of funds from these accounts. A very important disadvantage is that employees current and future are all now tied to the firm. So if the firm goes bankrupt, not only does he lose his job, he also loses his pension. Disadvantages to the firm is definitely the investment risk and regular funding obligation. So he'll have to continuously contribute funds so as to meet these liabilities in the future. If the firm has given early retirement options or other such options in the plan, then liquidity requirements may become significant if the employees exercise these options. And extra resources, a fund management team, due diligence team, etc. will be needed to maintain this account. For a defined contribution plan, the advantages to the employee that he is the owner, he decides everything, and assets can easily be transferred to another plan. He can diversify the portfolio to suit his needs. It can lower his taxable income because normally the contributions made to these plans are tax deductible. Advantages to the company, no financial liability other than matching the contribution, no investment risk, lower liquidity requirements in the longer term, fewer resources required to manage all these plans. So you just have to give a fixed payout. So you don't need an investment team and a due diligence team to, like you would in a defined benefit pension plan. Fewer regulations also for the defined contribution plan. The defined benefit plans are heavily regulated so as to ensure that the retirees' benefits are secured. Disadvantages, he has to take all the investment risk himself. He must monitor and make necessary reallocations whenever they are needed. And restricted withdrawal of funds, this was a problem with defined benefit as well. Disadvantages to the company, usually even though a due diligence team is not required, some investment policy statement and some details you still have to keep, some minimum number of investment options you still have to keep for your employees wherein they can invest their funds. So it's a relatively much minor disadvantage as compared to the defined benefit plan where much more detailing is required. The main part of our focus is going to be creating and managing the portfolio of a defined benefit plan wherein all liability is with the firm. So we'll start by understanding the investment policy statement of a defined benefit plan. Once again, like for the individual investor, the investment policy statement will have two broad sections, that is the objectives and the constraints. The two objectives again will be the risk tolerance and the return objective. In the individual investor section, we divided the risk tolerance as willingness and ability. In the case of institutions, there is no willingness. We would generally answer in terms of the overall risk tolerance. And our answer again will be of the form below average, average or above average. Depending on how many minutes are allocated to the question, will decide whether we will give one supporting statement or two supporting statements to the final answer. The second objective will be the return objective. For all institutions generally, there will be a risk and return. We'll study the specifics for defined benefit pension plan soon. The 5 constraints also remain the same. There's the time horizon, taxes, liquidity, legal and regulatory factors, and unique circumstances. In individual investor portfolios, we first made the return objective and normally then came to the risk tolerance. In the case of institutions and especially the defined benefit plan, it makes sense, rather it helps to first understand the risk tolerance and then come to the return objective. So that's the way we'll follow. Before you determine the risk tolerance, that is average, above average or below average, these are the 5 points that you'll have to keep in mind. First is the funded status. Underfunded plans will indicate a shortfall and a decreased ability to take risk. Underfunded implies that the plan assets are lower than the plan liabilities. If the sponsor financial status is not very good, that is the firm itself is in a bad shape, that is debt ratio is bad or profitability is bad, expected profitability is bad, then it implies a lower ability to take risk. Vice versa would imply a greater ability to take risk. The reason being, if even the plan makes a loss or even if our assets fall in value, the sponsor can help us with increased contributions. If the sponsor itself is in a bad position and the plan makes a loss, then he may not be able to contribute and make up for the loss also. Very important is to analyze the common risk exposures. That is the correlation between the firm's operating characteristics and the pension asset returns. So if our pension plan returns and the firm's operating performance, that is the sponsor's operating performance, are highly correlated, that means the risk tolerance is lower. Reason simple, when the firm does poorly, the plan also does poorly. So plan needs contributions and the sponsor cannot provide contributions. When the firm does well, the plan also does well, so plan anyways doesn't need contributions. So very important, you have to see the common risk exposures. In fact, you have to make an effort to ensure that if you are a steel company, then all pension plan assets should not be directed towards steel stocks or in the steel industry. You should try to diversify your overall exposure. You need to also look at the plan features, that is, if there are early retirement options or lump sum payment options, then these can be a strain on liquidity and decrease your risk tolerance. The characteristics of the workforce. So if it is a younger workforce, or a greater ratio of active to retired lives. So if this ratio is 2:1 or 2.5:1, then it normally indicates an above average risk tolerance, because the time horizon would be long, or the average time that these obligations become due would be relatively out in the future. So even if there is a loss, there is sufficient time for the fund to recover and make up for the losses. So active to retired ratio is another item that you will have to consider. You will balance all these 5 characteristics: the funded status, sponsor's financial status, common risk exposures, plan features, and workforce characteristics before you finally conclude whether your risk tolerance is average, above average, or below average. Again, a level of subjectivity will be required, but still it will be relatively less as compared to the individual investor portfolios that we studied. Now the return requirement will be jointly determined with the risk tolerance. So in every question involving a defined benefit pension plan, you will write your answer as the critical objective, and that answer will always be a standard constant, that is the minimum return requirement, that is the actuarial rate or the discount rate on the liabilities. So the critical will be the actuarial discount rate. If the actuarial discount rate is mentioned in the question, you will mention that percentage. If it is a subjective type question, then you can write the actuarial discount rate is the critical return. And the reason is simple. That is, if all assumptions of the actuaries were to be met, then if my assets grow at this discount rate, they would be sufficient to meet the liabilities whenever they are due. So the critical return or the minimum required return is the actuarial discount rate. Liabilities are going to be paid in the future. The PBO is the present value of those liabilities. The present values come by some discount rate. Even if no addition to employees, or even if the plan stops tomorrow, that is, employees stop working tomorrow, even then these liabilities will keep growing at that actuarial discount rate because you haven't paid them. So if you haven't paid them, they will keep accrue by a rate of interest, or they will accrue a rate of interest. That is the actuarial discount rate. If our fund at least moves at that actuarial discount rate, then it will be able to meet the obligations whenever they become due. So always, so you will attempt it as, I'm actually writing the answer here, okay? You will make two columns. Critical, write a colon or something and write actuarial discount rate. And you can further write that if you see liquidity needs are low and workers are young, use a capital gains focus. If there is high liquidity requirements and older workers, use an income focus, basically matching the liabilities with the assets. The desired objective would be to earn an enhanced return to minimize future contributions. So if we earn better than the actuarial discount rate, then employer may not need to contribute as much in the coming years. And if our return is particularly good, we may be able to generate a pension income as well. So just to revise, the pension expense we studied at level 2 was calculated as the current service cost plus an interest cost plus plan amendments plus or minus actuarial gains or losses. IFRS and US GAAP had differences, but never mind. Minus the actual return on plan assets. Actually, there was the expected return. We call this the economic pension expense or the actual pension cost. So I'm subtracting the actual return on assets. Generally, the objective or the minimum objective, that is the critical return objective, is that this actual return should at least meet this interest cost. That is, even if there is no current service cost, there are no plan amendments or no actuarial gains and losses, the liability will increase to the extent of the interest cost, and your funds should also correspondingly increase to the extent of the interest costs so as to meet the obligations when they become due. If you perform better, you will be able to minimize future contributions. If you perform really well, your actual return on assets may be so good that it makes up for the current service cost also, interest cost also, and all these other costs as well, so that you actually report a pension income or your pension expense is negative. This will normally not be required of a pension plan. So if you see a very healthy a very healthy financial statement or a very high ability to tolerate risk, then you will write a desired objective as enhanced return to minimize contributions this will be fine normally. If you really think he should go for it or the fund manager should be so aggressive, you'll write and generate and generate pension income. Constraints for most institutions will be pretty straightforward. So liquidity constraint, again, the answer would be high or low normally. So high liquidity requirements or low liquidity requirements is what you will write the answer as. Average also you can write, but normally I've seen it's pretty easily classifiable as high or low. Depending on the age of the workforce and the retired lives population, so more people drawing pension, more will be the strain on the plan. Ability of the sponsor to make contributions, if that is not there, then again liquidity needs are high, because as anything becomes due, the plan will have to pay it itself. Employer is not going to make any contributions. And the plan features, so early retirement, lump sum payment options again will put a strain on liquidity. Time horizon is generally long term, but again depends on the age of workforce and the retired lives population. Most plans in the world are moving from a defined benefit to a defined contribution type. So if you see specifically in the case mentioned that the employer will terminate the plan starting this date, then there may be a short term or an intermediate term time horizon. So the horizon is long in case of a going concern, short in case of a terminating plan. These institutions are usually tax exempt. If it is mentioned in the case, you would want to mention that in the constraint section as well. If you see some talk on taxes happening, you can just write tax considerations are important. Nothing more than that ever has to be written for this part of the section. In case of individual investor, this always used to be the answer. That tax considerations are important. If there is really too much tax mess given in the question, you will just add a few more words saying advise tax counsel. That's it. You never have, or you are not expected to be a tax expert by any stretch in the CFA curriculum. So this is the maximum extent to which you will go attempting this type of question. Legal and regulatory. So these plans are normally heavily regulated. ERISA is the institution in the US that regulates pension plans. You normally don't have to write this. Fortunately for you, you are not expected to be a regulatory expert at all. So the answer generally will be prudent expert rule applies. The prudent expert rule basically says that the funds should be managed as though they were your own and with a fair degree of expertise. So knowledgeable expert individuals should be allowed to manage these funds and they should invest them as if they were their own money. So fiduciary responsibility is encompassed in the prudent expert rule. You'll see this in detail in the coming slide also. This also implies that the plan must be managed for the sole benefit of the participants. Unique circumstances will be specific to each case. Some examples include insufficient resources to perform due diligence. That is, there is no investment team, or there is one person, or the CFO is also managing the pension plan. Special concerns relating to the sponsor, and if the firm has any socially responsible investing constraints. That is, no funds should be invested in tobacco companies or environmentally hazardous companies, etc., will be cited in the unique circumstances of the case. In the case of a defined contribution plan, the employer does not have to establish the goals and constraints. These will be done individually and differently for each individual. The employer only has to make investment alternatives available and to a significant degree explain them to the participants so that they are able to individually decide which schemes and which options they want to avail. So the issues that will be addressed in a defined contribution plan IPS would basically be: first, inform and make a clear distinction between the responsibility of the plan participants themselves and the fund managers and the plan sponsor. The sponsor is only responsible for making contributions and making certain investment alternatives available. Provide descriptions of all alternatives. Provide how these alternatives are selected and monitored. And establish an effective communication between the fund managers, plan participants, and the plan sponsor. So, more than a few hygiene-related factors with regards to availability and explanation, there is not much work that the fund manager or the firm has to do in the case of a defined contribution plan. So that winds up the discussion on the first and arguably the most important institution, that is the pension plan. We will do one example and make sure we understand all these concepts. So guys, we'll look at the question first before reading the case. The question asks us for the return objective, risk tolerance, and time horizon. So we don't need to bother too much about the other constraints. So Supra Dichem is a chemical dye manufacturing company based in Canada. The company sponsors the Supra Dichem pension plan, the purpose of which is to accumulate assets to fund the plan's obligations. Consider the following information about the company and its pension plan. The company has annual sales of Canadian dollars 300 million with profits of 30 million. Being a growth company, it's expected to grow by 11%, which is above the industry average growth of 8%. The annual payroll expense is about Canadian dollars 40 million. So guys, we can side by side make small notes. That is, sales are good, so indicates above average risk. Something like this, a tiny note you could made on each point so that you can weigh the above average and the below average points and make a final conclusion wherever there is contradicting information. Payroll expense is about $40 million. Average age of the workforce is 39 years. It is relatively young, assuming they will retire at the age of 65 or 70. There's still, or 60 also, there's still about 20 plus years to go. 25% of the participants are now retired. So, of the total workforce, for every one retired person, there are 3 people who are still working, or the active to retired life ratio is 3:1, which indicates again an above average ability to take risk. Assets are 90 million and liabilities are 81 million. That's also good. The plan is overfunded, again shows an above average ability. Duration of the liabilities is 18 years. That is, people will be retiring late, just indicates a long-term time horizon. Just to refresh, a time horizon greater than 10 years we will classify as long-term. Between 3 to 10 years will be classified as intermediate term, and less than 3 years will be classified as short term. The discount rate applied to the liabilities is 6%. This discount rate in a defined pension problem will always be the critical return objective. For any type of fund, be it an overfunded plan, be it an underfunded plan, depending on whatever be the state of the rest of the case, the critical return objective for defined benefit pension plan will always be 6%. The pension plan wants to generate a rate of return of 9% so that they can reduce their contribution to the fund and increase the employee benefits. And they additionally want to maintain 5% of the plan assets in cash. If there was a liquidity constraint asked, we would have mentioned this in the liquidity constraint. And the 9% gives us an indication of the desired return. So to answer the question, the return objective would be suffice to write critical, never mind. Critical is the 6% actuarial discount rate, and the fund's risk tolerance is pretty okay, so we can hope to achieve a desired return of 9% as stated. This would be enough to get full marks on the exam. if you had time left in the end, which would normally not be the case, you can come and write there can be a growth focus as risk tolerance is pretty good, etc. All that statements you can write, but this is enough to score full marks on the exam. 90% of the people will fail the level 3 exam because they have missed out or they have just not attempted a part of the morning type exam. So whatever happens, you have to ensure that you have written something in every question. There is lenient marking, there is stepwise marking. The examiner cannot give you any marks if you have not written anything. So in a 3 mark question, you'll maximum write 3 lines and you'll go ahead and you'll come back and write more explanations and details in case you need. There will always be space provided. So these templates are long enough to write. You will never have to write outside the template unless you've written a wrong answer and you've cut everything. Then probably you'll have to put an arrow and write on some other part of the page. As far as the risk tolerance is concerned, we would conclude that the risk tolerance is above average because practically every line that we encountered said so. So there is no problem with regards to the age of the workforce or the liquidity or the funded status or the financials profitability. So pretty straightforward. Time permitting, it's a 3 mark question. I would write 1 or 2 points. So overfunded. It's enough. Whole detail you don't have to write by so much $9 million, etc. You could also write time horizon is long term. You know the duration of liabilities is 18 years. You can say the average age of the workforce is 39. So by the time they retire, it will be 65. No explanation needed generally for the time horizon, but still we can write average age is only 39. You can also write duration of liabilities is 18 years. Both of them substantiate a long-term time horizon. So to treasury bills, we'll have to increase the allocation to 5% because that's what the case requires because they want to maintain 5% in cash. Now, please understand that the liabilities of a defined benefit pension plan are more like fixed income securities because a fixed pension payout has to happen till the time the employee dies after his retirement. So, definitely the assets have to have a lot of fixed income securities. However, more of the fixed income securities we don't need in intermediate term bonds with a 5 year duration because the question clearly says that the liabilities have an 18-year duration. So you can reduce the allocation. The total bond portfolio I'm okay with, but I don't want so much allocation to intermediate term bonds. I would want a higher allocation to long term bonds. So reduce intermediate term bonds. The reason we can write is liability duration is 18 years. Reinvestment risk and price risk both come, because if you don't match the liability, 5 years you will have to reinvest. You don't have to write. Okay, it's assumed. You said liabilities have a duration of 18 years. We are trying to match our assets with the liabilities. Increase US long-term bonds. We would want to increase, again for the same reason that we are matching the liability of, or we are matching the liability duration of 18 years. Now, with an above average risk tolerance, we definitely want equities in the portfolio. But clearly, we don't want everything in US equities only. We would want to allocate the equities to REITs, other international markets, or other developed markets, and to emerging markets. So the next four are also pretty straightforward. Decrease the allocation. You can write the reason as over concentration. In these cases, if your answer is correct, normally the reason won't make a difference. When the answer is wrong, you may get some points for the reason. So in questions that you are sure of the answer, don't try to write a big reason. In questions where you are unsure of the answer, try to write a big reason to append your answer. Because in case the answer is wrong, we'll give you some marks for the reasoning. To equity REITs, international developed market equities and emerging market equities, for all of these, we can write the allocation should be increase, and the reason will be to maintain the above average risk. Help in meeting desired returns. So we'll again look at the question first. So justify the objectives on the same three areas again: return, risk tolerance, and time horizon. 10 years have passed. The company has approached Eva Miller to manage the pension plan's investment policy and strategic asset allocation. Consider the following updated information. The top line and bottom line are steadily declining. The company has entered a maturity stage and has a growth rate of 8.1%, which is just above the industry average of 8%. Definitely an indication of average to rather below average tolerance, since he mentions the degrowth. Average age of workforce is now 52 years. Again, indicates a below average risk tolerance. 65% of the plan participants are retired. So the active to retired ratio has now gone down to below 1. So definitely, again, an indication of below average risk tolerance. The plan is underfunded by 20%. So question is again relatively straightforward. As we see, most of the indications are towards a below average risk tolerance. The duration of the liabilities is now 6 years. So the duration is 6 years. The maturity would be normally a little higher. So you can argue for an intermediate term time horizon, or even a long term time horizon, but it has definitely reduced considerably. The discount rate applied has gone up to 10%. So the return objective, or in the return objective, you will mention that the critical return needed is 10%. Again, you will write this is the actuarial discount rate. There's no question or there's no need to mention a desired return in this case, because anyways meeting this 10% critical return looks quite difficult considering the risk tolerance of the plan, which is now gone below average from above average earlier, and all points that we mentioned earlier have now reversed. So they will all support our argument for a below average risk tolerance. The time horizon you can say has considerably reduced, or the time horizon now would be intermediate term, and you can support that by saying that duration of liabilities is 6 years. Another variant of a defined benefit plan is a cash balance plan, wherein the company defines the benefit in terms of an account balance, which the beneficiary can take as an annuity or as a lump sum, or transfer it to another company if he so desires. So the benefits are still defined as a percentage of the salary or a percentage of the years of service. However, an account balance is maintained. This account balance is normally a paper balance, that is, the company will not pay it right away. It will be paid only at retirement or only when the plan matures. However, the account will get a credit each year. So there will be a pay credit because of the employee working and an interest credit because of the last year's liability that is due. So the management and the economics of this plan is similar to a defined benefit plan. However, this account balance makes it easy to transfer this plan from one employer to the other. It's called a cash balance plan. So paper balance only, representing a future liability of the company. Another kind of a defined contribution plan is the employee stock ownership plan, wherein the company says that for every year that you work and depending on your seniority and salary, there is a particular number of stock options that the employee will be given. So what will be the value of that stock in the future, nobody knows. The company also doesn't know and doesn't guarantee. The company just guarantees that for every year that you work, you will be given so many stock options, and the value of that option from any option pricing model can be determined and will be the expense that the company will have to take. We now move on to the management of foundations and endowments. So although separate, these terms are often used interchangeably. Foundations specifically are grant making entities that are either funded by gifts from individuals or corporates, and they have an investment portfolio. Endowments are also similar long term funds owned by a non profit institution and generally supporting the functions and the day to day operations and expenses of that institution. Both of these are generally not for profit. They serve some social purpose like funding a museum or a zoo or a library, generally not taxable, and have an infinite time horizon. The Nobel Foundation, for example, gives the Nobel Prize every year. Foundation and endowments generally can and should pursue aggressive objectives because of their infinite time horizons and no contractual obligations, as you will see. We just quickly browse through the various types of foundations. So, independent are funded by a private or a family. The purpose is to make grants to public groups and institutions. Source of funds is, like the name suggests, individuals or families. They generally have an annual spending requirement. So, for a foundation, for example, it is 5% of the total assets. Company sponsored foundation is sponsored by a particular corporate and again has a similar purpose as the independent foundation. Again, there's a minimum spending requirement of at least 5% of the total assets need to be spent every year. Operating foundations are established to fund an organization, for example, a museum or a zoo or some medical research initiative. Funds can be individuals or families, and they are required to spend at least 85% of the dividend and interest that the portfolio has generated for the operations of this institution or this organization. Community sponsored foundations also give grants to public groups. General public has donated into these foundations and they don't have any minimum spending requirement. So you do not have to remember these spending requirements. These are generally the requirements for various foundations in the US, and We've discussed them as an example of what foundations are and what they do. Moving on to the more important aspect of the investment policy statement for a foundation. So, the perpetual time horizon may generally require a preservation of real purchasing power. That is, the foundation must achieve at least the inflation rate so that the purchasing power is maintained. Generally speaking, in most questions, you can apply the minimum return criteria or the required return criteria as the required payout, for example, 5% in the two institutions that we saw, plus the expected inflation, plus the management expenses of the fund. You can do a simple summation, or you can do a geometric mean or a compounded summation, that is 1 plus the required payout into 1 plus the inflation into 1 plus the operating expenses minus 1 as the minimum required return. Both are acceptable according to the curriculum. The risk tolerance for foundations is generally moderate to high depending on the spending rate and the time horizon. So if the foundation is going to be closed down, or if there's a very high spending rate, that is 20-30% is required to fund the operations, then it may have a below average risk tolerance at times, but normally it is moderate to high. And reason the tolerance is high is because there are no contractual obligations. Like a defined benefit plan, there is no fixed sum of money that is guaranteed to anyone. The requirement is only 5% of the assets. If the assets go down, 5% of the assets can also go down. There are no contractual fixed payment obligations. The liquidity constraint is generally only the annual spending that has to be done. Some foundations choose to hold some portion of the annual distribution as cash. So if that is mentioned in the case, you can write it as a liquidity requirement for that particular case. Time horizon is usually long, rather very long. Generally, they are not taxable. If there are some concerns, you can always mention them. Not many legal and regulatory issues also, so you will write that the prudent investor rule applies. That is, the money has to be managed with fiduciary responsibility as though it is your own money for the best, in the best interest of the institution that the foundation is serving. No major unique circumstances have also been seen, but there may be some specifics in a particular case on restricted investments, socially responsible investing, so on and so forth. So the investment policy statement for an endowment is very similar to that of the foundation. The return objective involves preserving the capital base, that is, have enough appreciation so as to meet inflation, and use the income generated for budget needs, or you can even sell a part of the portfolio for the organization that the endowment is funding. Generally speaking, the return requirement can be the same as 1 plus inflation into 1 plus the spending needs into 1 plus the administrative expense minus 1. The risk tolerance is also moderate to high. However, if the percentage spending required to meet the overall budget of the organization is very high, then it may sometimes indicate a below average ability to take risk. Time horizon is infinite, so again generally indicates a high ability to take risk. Liquidity requirements only to the extent of spending needs. If any large outlays are expected, then liquidity requirements will be higher. Time horizon is usually infinite, tax exempt institutions, and just like foundations, the prudent investor rule applies. Unique needs also will be specific, if any, to a particular endowment. So let's look at a question and try to make an IPS for an endowment. So we'll again read the question first. It wants the objectives for the foster care endowment fund, and again we're asked the return objective, risk tolerance, and the time horizon. So foster care is a non-profit organization located in the United Kingdom that supports and cares for orphans. They provide the abandoned kids with food, shelter, clothing, education, and healthcare. It was founded by Mr. R.J. Johnson. He believes everyone has a calling. In his case, God put it on his heart to get involved with the children missing the love of a parent. The foster care endowment fund is set up to provide the operating budget. With his strong social influence, he managed to accumulate £30 million from like-minded people to fund his cause. Assume a spending rate of 8% and that inflation is expected to be 4% annually. So for the return objective, you can write that there is a required return that should be enough to meet the spending requirements as well as maintain the purchasing power, which will come out near about 12%, 12.32%. Now, generally, endowments have an above average risk tolerance. But in this case, we see that 12% of the funds are required, or 12% of the assets are required every year to meet the objectives of the endowment. So, the overriding principle to think about risk tolerance is to ask yourself that if the portfolio suffered a major loss, how badly would the ability to meet critical objectives be affected? So, if this portfolio were to halve, then to meet the requirements of the endowment, we would need 24.42 or 24.6% return. Because on $30 million, the endowment needs 12.32%. So we would conclude that the risk tolerance, even though it has an infinite time horizon, would be below average or at best average. So long time horizon supports above average, but high spending requirement argues for below average. So in this case, either answer, average or below average, in my opinion, would have sufficed, provided you gave one reason in the bracket. So we will say, for example, below average, and the reason cited would be high return requirement. Time horizon we can mention as long term. So there will be a large enough template given where you can answer. That's fine. 12.32. It also says below average because it relies heavily on the contributions from the endowment fund. Time horizon is long term. From the following asset allocations, select the one allocation that best serves the needs of the endowment fund and justify its selection by maximizing the following three criteria simultaneously: the return objective, diversification, as well as efficiency. So the return objective, please recall, was 12.32%, and we will evaluate the diversification and the efficiency. Efficiency, please remember, means the Sharpe ratio, or implies the betterment of the Sharpe ratio. The market portfolio or the efficient portfolio, remember from Markowitz's efficient frontier analysis, is the one that has the highest Sharpe ratio. So let's evaluate the portfolios. Portfolio A is invested in UK stocks, bonds, treasury bonds, has an expected total return of 9.1%. So A is definitely not the right choice as it doesn't meet the return objective. You see, all B, C, and D, even D doesn't meet, so the job has become relatively simple. Both B and C meet the return objective. Diversification, we can see, is definitely much better in B, and even from a portfolio management perspective, it has an effective ratio of corporate and treasury bonds, which is non-existent in portfolio C. So there's too much concentration to real estate for a below average portfolio, and too much allocation to cash for any portfolio. So treasury bills have 20%. This is normally not an ideal situation ever. So this should definitely be allocated more to corporate bonds and treasury bonds, and so should be done with the real estate. So C may be the most efficient, as we can see from the higher Sharpe ratio, it's marginally better than portfolio B. But when looked at the three criteria simultaneously, portfolio B seems to be the portfolio of choice, satisfying all three conditions. The cash flow yield basically indicates the dividend and coupon income from the portfolio. So if the clients had stated any such preference, this would have come into play.